Good morning, ladies and gentlemen. Well, last week we had the QRA and nothing changed. The odds were slight that it would. Basically, it was a copy-paste of the previous one, which is not really surprising given that Scott Bessent hasn't had time to really put his feet under his desk. Let's talk about what his aims are. And let's talk about this chart because this is what he wants to change. So what is his famous 3-3-3 plan? He wants to pump 3 million barrels of oil, and I'll give him that one, through deregulation and giving out more permits and all that stuff. I'm sure that he can achieve that because that is entirely within the purview of the presidency, and he doesn't need congressional support for that. Secondly, he wants to have GDP, real GDP, at 3%, coupled with the deficit at 3% as well. So he wants 3 million barrels of oil, 3% deficit, and 3% real growth. How likely is the deficit to come down from the 6.5% at the moment to 3%? Well, it's going to be very, very difficult to achieve that one. It's going to be almost impossible. Whatever mathematics you come up with, if you extend the tax cuts from 2017, it's going to be almost impossible to bring the deficit down to 3%. But his aim and what he has told Donald Trump, now whether he has persuaded Donald Trump or not, who knows. But what he wants to do is, instead of looking at the success of policies through the stock market, to look at them through the yield of the 10-year note. And he has made that very clear. He's not looking at Fed funds, he's looking at the yield of the 10-year note. So all his policies will be aimed at reducing the term premium. He wants to flatten the curve. He wants the term premium to come down, and he wants the real rate to come down. Basically, he wants to go back to this period somewhere around the beginning of 2022 or the middle of 2022, where the real yield was roughly zero. The only way he can do that is by bringing down the budget deficit and having relatively high growth, not fighting the Fed, i.e. letting the Fed fight inflation through higher Fed funds rates and keeping restriction on the economy. The only problem of that is that even if you were somehow, through some miracle, to achieve a budget deficit of 3%, which is terribly unlikely, whatever maths you use, it's very unlikely to come down below 5. Getting real rates to go to 3%, i.e. getting the GDP, real GDP, up to 3%, when the longer term growth potential of the economy is 1.5% without inflation, is going to be enormously difficult. But I get what he wants to do. He wants to reduce the 10-year yield, and therefore he wants to flatten these curves. He wants real yields to come down towards 1%, let's say, and he also wants term premium to come down towards zero. These are all flattening policies, i.e. he wants a flatter curve. It's going to be terribly, terribly difficult, and I don't think he's going to achieve that anytime soon. But if he puts policies in place which try to achieve that, he can certainly reduce term premium by 20-30 basis points over the course of a year. But I really can't see how he can do much more than that. The data that we received last week all show that the economy is doing just fine. It's strong. There are no problems at the moment. Unemployment is not going up. So what is the market doing? The market is taking Besant seriously, and it has flattened the curve a little bit. If you have a look at twos, they're trading 429 and fives 435. 10s 450 and 30s 470. General collateral is 433, 435, depends on the day as it were. So the twos, who is going to buy the twos and why? Why are people, buying twos here? Why lose 4-5 basis points per day unless you think that the Fed is going to cut at some stage fairly soon? Well, I personally think that March is now well off the table and that twos are just going to meander with people buying them as soon as they're not losing money on their positions day to day. So as soon as twos go above 435 and 442 seems to be the ideal, there will be buyers. So twos won't be going too far away from where we are now. Why buy fives below general collateral? I just can't see it. I think that fives are stuck as well, and then it's a question of where the 10s and 30s go, and basically that is a question of how steep the curve is and also where the term premium is and real rates. That is the bit that he wants to flatten. I think it's terribly, terribly unlikely that he can do that while the data is so strong. And the only way he can do that is if the inflation rate slowly starts coming down while the Fed maintains the restriction. They say the policy is currently restrictive, and it might be, but they have to maintain at least that level of restriction to keep on wringing inflation out of the system. If they do that, where are 10s going to go? I mean, the curve might flatten very, very slightly, but given the fact that we keep on getting a lot of auctions because the budget deficit is what it is, it's very, very difficult for the yield curve to flatten much further. So let's have a look at 2s, 10s. I think that minus 12 is going to catch it without too much problems. And there I would actually like to start looking to do steepeners as opposed to flatteners. The flattener is working at the moment because people are they're giving Besant some benefit of the doubt. I doubt it can continue. 5s, 30s, I think also are going to find it very, very difficult to go through minus 29. We have the 200-day moving average coming down. I think minus 29 here is going to be a big, big battle. Why will the curve really start going through minus 29 anytime soon? I really don't see it. The data would have to start getting really weak. I really don't see that the market is going to bust through that level anytime soon, not with the auctions that keep on coming up. So I think that Scott Besant really does have his work cut out for him. He might get a 10-20 basis point flattener out of all this, but I think the natural tendency of the curve will be to steepen again, and I'll be looking for levels to put on steepeners. I'm not going to fight the flattener till probably this kind of level, but after that I think you really have to start fighting it and preferring the safety of the 2s and the 5s over the 10s and the 30s. For the time being, you give him the benefit of the doubt, but it's not going to last all that long, I don't think. Let's have a look at 10s, 30s, because next week we have auctions in both. And you can see that even though we had some switching out of equities into bonds last week, really the move was minimal on a week-to-week basis. We basically were down 4 basis points in total, which is nothing much. I think the first couple of days we are not going to be below 450. I think they want the auction to go off above 450, but anywhere near 556 to 558, I think the odds are good that we retry the downside. So I will be a buyer up there. And in the 30s, if we can get around the 475 area for the auctions, I think it's probably a good buy for a retest of the 460, 465 area. I think for the time being, people are going to give Besson the benefit of the doubt. They're going to try to do some flatteners or get out of their steepeners. So it will be a trading range with more potential towards the downside, towards the 450 area. But I just don't see how the market is going to be able to go much better than it is at the moment. I mean, it's already the best part of 30 basis points lower than these highs. So really, I'm not looking for much more than 455, 460 over the course of the next couple of weeks. And it's a trading range. Every time it goes up, there will be buyers, simply because of what Besson wants to achieve and what his targets are for the long end. Don't forget, if the focus really becomes on the 10-year and they want to flatten the curve and they want to get rid of term premium or lower it and they want lower real rates, the only thing that the market can do is give them the benefit of the doubt until it sees some policies which are inconsistent with that. At the moment, the policies the market is getting through Doge, the cost cutting, are consistent with those aims. Nothing that they've done, and also the tariffs, don't forget, because the tariffs are not over by a long chalk. So we will get this tariffs on, tariffs off, and the tariffs are really, how shall I put it, they are bound to cut growth, and therefore they are a risk-off sentiment at least, and the market will prefer bonds to equities whenever tariffs come up, and tariffs also cut the deficit. So they are tax instruments, as it were, and therefore the market is unlikely to run away to the upside. So it's a trading range. 475, you buy some 30s, you set a 5 basis point stop, and you see if it works. In Europe, it's basically steady as she goes. There's very, very little likelihood that we can go up in yield in Europe, simply because the economic situation is what it is. I really don't think that we can go below 190 in the Schatz or below 2% in the bubble, or really much below 230, or even fill this gap, let's say 225 in the Bund. This is not where the action from now on should be. We've basically retraced and we are at neutral, as it were. Are the ECB going to cut rates so fast that we get a positive carry in the 2s? I really don't think that, with all the news that we had last week, and when they had an opportunity to panic lower and basically they didn't, that we are likely to bust this 190 to 195 area. anytime soon. I think anywhere down there, it's get out of any positions that you have and wait, because I think there will be bounces back up to the 220s, and I'll explain it now. So this is a chart of the differentials between the 2s. I think it's very unlikely that we bust to 234. Neither Germany needs to cut that much, nor the ECB will cut that much, nor will the US rates move very much in the short term. So I think that this spread is getting to very, very thin air, and that really we are going to be somewhere around here for quite a long time. Now, what actually Besson wants to achieve is a flattening of this spread of the 10s. He wants this spread to come down towards these levels again, you know, the 180s, the 175s, or even lower. I don't think he's going to be able to achieve it, but I think the market now is going to view this 205 area as quite a bit of a top. Because let's face it, he really wants these spreads to come down, the differentials between Europe and the US to come down, even though the growth in Europe is diametrically opposed to the growth in the US. So that is what he really wants to achieve, and that necessarily means actually a lower dollar. The only way this spread is going to come down is if the dollar starts weakening. And whether it's going to be a chicken or an egg, I don't know. But if this spread starts coming down, the dollar will weaken. So he is looking to set a top at, you know, somewhere around these levels in the spread between the US and Germany. To me, that probably means that Germany is stable at these yields and he tries to bring down US rates. But I don't think that he's going to be successful in the short term. I think in the short term, all he's going to be able to do is set a top around the 220 area. The data, I don't think will allow it for the time being to be anything else, unless CPI starts going down very fast. But I really can't see how that's going to happen. It's going to take many months of CPI coming down for the Fed to be able to cut. In the meantime, the curve can flatten a little, but really having 10s below general collateral, I think, is a pipe dream for quite some time. It became obvious last week that 109.25 is a very good top for the dollar, and no way are we going to go through it for quite some time. I think the pressure is going to continue to be towards the downside, towards this 107 area and this 0.382 retracement of this whole move up, which is around the 106.5, call it, level. That is going to continue to be the pressure. The problem is that the euro is actually quite weak. The euro really can't make much headway, and Besson needs the euro to go back up to this kind of area, 105.70. But what he is managing to do is weaken euro yen. Euro yen is breaking down. As I told you, every time it got up to 163, 164, 165, it's a sell. And euro yen is looking like it can break down at some stage. And once it breaks this 154 level, it really can go at least down to 143. What does the Japanese yen look like? Well, it looks like it can start motoring down towards 144 area. That is something that I expect. That is how I expect the DXY to actually weaken slightly. DXY down to here, mostly via the yen down to 144, and some modest improvement in the Euro USD, let's say 105-ish for the time being, but that allows Euro JPY possibly to break down and come down towards 150 over the course of the next couple of weeks. Commodities went absolutely nowhere last week, very tight range in GSG, and there's no reason to expect them to start going higher, simply because if Besson wants 3 million barrels of oil, then there's going to be a cap on GSG. And what is interesting is gold over GSG, and it keeps on going higher. And I think every time it dips, it will go higher. So let's have a look at the macro theory behind this. If Besson succeeds, there is a natural cap on the price of oil, and if anything, the price of oil will go down. But also, it will flatten the curve because there's going to be less inflation, and that is his theory, not mine, that the price of oil coming down will actually bring down the price of everything. Therefore, if the Fed remains tight, because they say they're tight, that will slowly wring inflation out of the system. It's also going to be not good for growth, right? So the price of commodities will stay lower, and gold will actually be able to do better because both the dollar will be weaker and also the bonds will be doing better. So it really is something which favors gold over commodities. His plan favors gold over commodities. It's just as simple as that. So anytime there's a dip, you should be getting out of commodities or buying gold GSG, because it just makes sense to me that we keep on going higher and busting through this 1230 at some stage. And last week, certainly gold and bonds outperformed SPY. Gold was up about $50, the TLT was up about a point, and SPY actually closed the week very slightly down. So I still see this continuing upwards, at least to this level over the course of the next couple of weeks. Everything that the government is trying to do in the US points to this going higher. If they are now concentrating on the yield of the 10-year note, they cannot be concentrating on the stock market. And that naturally should bring people in to buy 10 years at level, the Chinese to continue buying gold, and the stock market to really doubt itself. So finally, let's have a look at gold itself. I think that as long as it stays above 27.90, the immediate impulse is going to be towards higher prices. I think next week, if you get the bonds slightly weaker to start off with because of the auctions, and CPI is no big deal, i.e. it doesn't hit bonds hard, I think that any dip down towards 2800 in gold is an opportunity to buy call spreads, because I think it's going to be still one of the favored assets, gold and bonds over SPY. So let's have a look at my clean chart with the levels, and let's see what the stock market did last week. It opened in the panic over, blah, 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 up to 60.90, complete failure at 60.90 on Friday. This step to me says 58.64. That's what it says to me, and I can't help it. I'm just not positive of stocks at the moment. I think there are better alternatives right now. I think as I said, gold and bonds to me are better alternatives. does not mean that the stock market falls apart. It just means that it's out of favor for a bit. I really think that this gap here needs to get filled, and that's 58.64 to me. I can't be clearer. Now, we all know that there's no way that SPY can go down to 58.64 unless it gets help from the Nasdaq and the big stocks there. And let's have a look at what happened last week there. Again, complete failure here at 21,800. All the Bollinger Bands coming in. I would have thought the first stop is going to be 21,100. At some stage, and I don't expect it to be Monday, you really need to see this gap down here filled, and a break that is going to put some panic into these people who are long from down here. And this is the real support, 20,664, which goes all the way back here, as you can see, the previous high. I really would like to see these levels retested, few bounces, and then we go, then we decide what we do and why. At this moment, I really don't see that the stocks are a good buy. I really don't see that adding risk up here makes any sense at all. It would make sense to me if there was a different policy in place, but a policy of reduction of the 10-year note, it's too soon for equities to benefit from that. That to me means lower growth. What was interesting last week was that the Nikkei just couldn't go higher, even when all the other markets were rallying to close the gap. And as you can see, it never really closed the gap. It never, where it opened on Monday is where it basically traded, and then on Friday it actually went down. This to me is bearish, and actually confirms my view that the yen is going to be a strong currency for quite some time to come. I think the meeting between Trump and the Prime Minister of Japan on Friday, and the fact that Trump said that he wants to eliminate the trade deficit with Japan, means that the yen is now going to be stronger currency, and that the Nikkei is one to avoid for the time being. I think it can easily break down towards the 37,000 level. So stay away from Nikkei, and if you got some, get rid of it. I don't think equities are the place to be for a while. Having said that, volatility actually says that equities are in a range and they're not going anywhere fast. So the bottoms, the 58.64 level is actually a buy level, as opposed to, my God, it's going to crash. Volatility just says that we are in a range between the 15s and the 19s. That's what volatility is saying at the moment. So don't look at what I've just said as I think equities are going to crash. I just think that equities are going to be the least favored asset class for a bit. And I've long regarded BTC as some kind of a risk-on asset. And the fact that it keeps on failing to break 106,230, which is the highest close, and every time it gets up there, there are, a lot of sellers, I think makes it more likely that we take out stops below the lowest close here, which is that one, 91,845. Take out those stops and come back in and trade sideways. Everything that I look at tells me that it's not a risk-on period, and therefore that you sell rips in equities. To sum up, unless CPI is a complete miss, which I don't expect it to be, I think CPI is 90% likely to be in line, then you want to buy some 10-year notes on the backup to the auction. If you can get them around 454, 458, great area to buy them. I think the risk reward there is pretty good. And that should mean that gold is going to do well from a backup. And if you can get it, at the levels that I showed you, it's great. Otherwise, I think the equities are really not the place to be. I think that any rip is a sell, or you want to continue to buy put spreads, because I think it's much more likely that the market goes down than up. Thank you very much indeed, and tweet you tomorrow.